Welcome, and thank you all for joining us today for our Landlord Learning Series. I'm Ayanna Pointer, Housing Choice Voucher Landlord Liaison, and I'll be your moderator today. The City of Norfolk's Department of Neighborhood Services and Norfolk Redevelopment and Housing Authority have teamed up to help promote the Rent Ready Norfolk program and the Housing Choice Voucher program. These two programs are essential to tackle our main objective, to create more affordable housing stock in Norfolk. We would like to encourage all landlords with rental properties in the City of Norfolk to consider renting through the Housing Choice Voucher program, which will provide you a guaranteed monthly rental income. Available units are advertised on our referral listing, which is shared on our website, NRHA.us. If you're interested in becoming a HCV landlord program participant, please complete a referral listing application, which can be found on our website, NRHA.us. The Landlord Learning Series is designed to empower landlords with information to make informed decisions. We are hosting monthly sessions on a range of topics. Today's topic is about tax strategies every landlord should know to increase cash flow. We'll hear from two presenters today. Our first presenter is Mr. Matt Needam on tax strategies advantages for landlords. After, Ms. Dawn Scott, who will discuss tax credit programs available to landlords. I would like to go over some housekeeping items today. I will ask that you all please hold your questions until after the presentations. In the meantime, questions can be added to the chat box and we will address them at the end. Also, a copy of both presentations have been added into the handout section on your display screen. At the end of this session today, you will receive a survey. We would like your feedback to improve these webinars. We will also like to know other educational topics you'd be interested in. So without further ado, I would like to introduce our first speaker, Mr. Matt Needam, Director of CSG Strategic Tax Consultants. Mr. Needam, thank you for joining us today. The floor is yours.
All right, glad to be here. Thank you guys for having me. Definitely look forward to giving you guys some good tips as far as tax strategies go. I'll try to make this as entertaining as possible. You know, taxes aren't the most interesting thing in the world, but there's an old saying that there's two things you can't avoid in life. That's death and taxes. And my hope at the end of this presentation is that I help you guys at least avoid taxes. A little bit about myself. I'm a graduate of Virginia Tech. I have an electrical engineering degree. I worked for Wall Einhorn Schnitzer since 2008, and I'm currently the director of CSG Strategic Tax Consultants. So it's a subsidiary of Wall Einhorn Schnitzer. I have a lot of experience in commercial real estate. I've been doing this for over 15 years. A couple other areas that I work in is research and development tax credits, energy efficiency deductions and tax credits, and a host of other tax strategies that are focused in the real estate space. The cool thing I like to, kind of hang my hat on is that I've helped my clients generate, over $1 billion in tax savings. So I'm really proud of that, helping clients save money. So the agenda for today, we're going to talk a little bit about cost segregation. We'll dive into active and passive income and losses. Talk a little bit about qualifying as a real estate professional. Part 4, recapture facts versus myths. There's a lot of misconceptions about recapture. So hopefully at the end of this, we'll clear some of those up. We'll also talk a little bit about the energy efficiency incentives such as 45L tax credits and Section 179D deductions. And then finally, we'll have some takeaways for you guys. So cost segregation, I like to call it a landlord's best friend. A little bit about the history of cost segregation. It's been around for a very long time. However, in 1997, that was a major court case, which was Hospital Corporation of America versus the IRS. And the idea of this court case was that a building, as most of you know, you own buildings, is composed of various components, right? So you've got a roof, you've got walls, you've got windows, HVAC, electrical, plumbing. All of these individual components make up a building. What HCA was going for was to state that that the building, while a building as a whole is a building, these individual components can be broken apart, and they actually won. And being able to break apart these components of a building into separate individual components allows you as a taxpayer to be able to accelerate depreciation on certain assets. So that was a huge court case, and it really kind of set the stage for real estate to kind of take off in this space of being able to accelerate depreciation. So a cost segregation study is a tax strategy that is used to accelerate depreciation, which in essence reduces your taxes and increases your cash flow. It is based off of engineering principles. So I know a lot of you may ask, how is an electrical engineer, diving into taxes? Well, it's because with a cost segregation study, you have to have the engineering knowledge and understanding of how buildings are put together and how electrical distribution panels are distributing power throughout the building to be able to accurately accelerate the depreciation based on IRS guidelines. So what type of owners can benefit from a cost segregation study? If you have a commercial property with a depreciable basis of $300,000 or greater, then you may be a good candidate. And that number used to be a lot higher. It used to be about $750,000 to $1 million because prior to 2017, you were not able to take 100% bonus depreciation. And let's talk a little bit about bonus depreciation real quick. What bonus depreciation is, it allows you currently under the current tax law to immediately write off 100% of an asset that has a class life of 20 years or less. And we'll dive into it a little bit later of how we can segregate the building into these various lives. But that is critical. Part of the Tax Cut and Jobs Act of that went into effect late 2017 allow real estate owners to take 100% bonus on all of these assets. So when you purchase a property, you're able to write off a huge chunk of it in the very first year, which in essence reduces your tax liability and helps you have cash to do other things, whether that's reinvest in other properties or make improvements to your existing properties. So keep in mind that $300,000 is depreciable basis. So if you go out and buy a piece of real estate for $300,000, you will not have $300,000 of depreciable property because you'll have to back out land out of that. So just keep in mind that $300,000 is depreciable basis. So why is it a good idea? I've already kind of touched on this. It's going to maximize your tax deferrals, which is always better to keep your money instead of giving it to Uncle Sam. Because I can promise you that you guys as landlords know what to do with your money better than our federal government. So you want to always, keep the money with you versus paying it in taxes. You can minimize your taxable gains on the sale of a property. And we'll talk a little bit about gains later in the presentation. So the primary property recovery periods. Typically, you've got buildings that are 27 and a half. That's going to be your multifamily or single family homes. Any kind of residential rental property would fall into 27 and a half years. Commercial properties that, office buildings, retail stores, restaurants, anything of that nature would be a 39-year asset. Land improvements, those are any improvements to the land, such as parking lots, sidewalks, things of that nature, get a 15-year life. Furniture, fixtures, and equipment, 7-year. And distributed services, information systems, these are various assets within the property. We tend to call them personal property. So that could be anything from carpeting, lighting, specialty plumbing, things of that nature. We can take a 5-year life. So as you can see, when we think about the 100% bonus depreciation, any of those bottom 4 categories, I can immediately write off in the year I acquired the property, which can be pretty significant. So the average value misclassified by property type, right? So often I see so many depreciation schedules where taxpayers are just leaving dollars on the table because they're just taking straight line depreciation. They're not accelerating the depreciation. And you can kind of see from the list here, they're misclassifying, in some cases up to 60% of their property is being misclassified as a 39 or 27 and a half year property asset, and we can accelerate that depreciation so much quicker than that. So you don't want to be in this part of this group that is misclassifying the property. So let's talk a little bit about examples of reallocated personal property. Flooring, counters, cabinetry, specialty lighting, specialty electric and plumbing, temperature control, HVAC. And so let me kind of touch on that. Temperature control HVAC implies that if you have HVAC that is serving a purpose other than comfort of people, right, we can take it as personal property. So let's say you own a self-storage facility that has temperature control that is to keep the storage facility at a certain temperature for the items that are being stored. You can take all of that HVAC as specialty HVAC and write it off in the year in which you acquired it. So that's pretty critical, that you want to be able to segregate your building into these various components using this approved IRS method. Some examples of land improvements would be asphalt, concrete, pavers, parking lot lighting, curb and gutter, retaining walls. Pretty much any exterior improvement that is to the land, we can take as a 15-year asset. And again, with the 100% bonus depreciation, this is important because it allows you to immediately write those assets off. So let's walk through an example of a rental home. So in this case, this was a rental home that was purchased for $400,000. We moved $100,000 of it to land, and then we had a depreciable basis of $300,000. We did the cost segregation study, and we were able to break it into the various components. And you can kind of see there under the cost segregation column that we've got $195,000 is actually 27 and a half year, but we moved $30,000 and $75,000 to a shorter life. The cost segregation study in this case resulted in over $100,000 more in depreciation in the very first year. So if this person had bought this home and just put it on their books as a straight line asset, they would have been missing out on $100,000 of depreciation in that first year. And that can be critical, especially as tax season comes, as we're in right now, when your accountant's telling you you owe some taxes. That depreciation would have been great to have. Let's use a retail store example. In this case, we've got a $4 million purchase. We moved $800,000 of it to land, leaving us $3.2 million in depreciable basis. And you can kind of see the numbers there. We've accelerated depreciation and generated over $700,000 more in depreciation versus just taking it as a straight line asset. So I like to use a dollar is worth more to me today than it is tomorrow. Well, that may not be true in the current inflation situation, but typically under normal circumstances, you would much rather have your dollars today than you would waiting 39 years to get all of this depreciation on this property. So there's another thing that may be important to you guys is catch-up depreciation. So let's just say, for example, you've owned a property for a number of years and you've never heard of cost segregation till today, and you come and say, hey, Matt, I want to look at taking some depreciation. Can we accelerate depreciation on something I've owned for a number of years? Yes, you can, and that's called catch-up depreciation. The idea here is that we can look at the depreciation that you've missed over all the years in which you've owned the property, pull all of that missed depreciation into your current year and take a huge deduction in the current year. So these types of analysis can be huge benefit to property owners. Here's an example. In this case, it was an apartment building that was capitalized with $6.5 million between 2007 and 2020. Doing a cost segregation study, we reclassified 1.6 to 5-year and 520,000 to 15-year. We were able to pull the missed depreciation into the current year using what is called a Section 481A adjustment, which was over $1 million that was adjusted on their 2021 tax return. This generated over $375,000 in cash for this particular client. So, I mean, the savings can be pretty significant, and I highly recommend if you have a property that you've owned even for 10 or 15 years, it may be worth taking a look at doing a catch-up study on. So the benefit, your typical cost segregation study runs anywhere from, as low as, depending on the size of the property, it can be from a couple $1,000s to, $20,000. It's a wide range, but the savings and the return on your investment is significant. And you can kind of see from this chart that, I mean, we're talking on an apartment complex, 4,000% return on your investment. That's pretty significant. So part 2, active versus passive income and losses, right? This is very important because I've been talking about all of this great depreciation, but the question is, can you actually use this depreciation? And that is where sometimes landlords and real estate owners get caught and not necessarily understanding the active and passive income. So active and passive income characteristics. So the main thing here is, and a lot of you that are on this webinar today may actually fall into this, where you may have a 9-to-5 job and being a landlord is kind of like a side job for you. So let's just say you work for an accounting firm like I do, and also own some real estate. My W-2 wages that I earn from the accounting firm would be considered active income. The income that I get from my rental properties would be considered passive. And so I won't, bore you guys with reading all of the different characteristics, but the key is the 4th bullet, which is basically saying that passive losses, so losses from my real estate, cannot offset my active income, which would be the income from my from the CPA firm that I work for. So you have to keep that in mind. We can generate all of this depreciation for you guys, but depending on your situation, you may be limited by whatever income that you are gaining from these properties. But there are ways around that. We'll talk about that in a little bit. More on the active passive income. So what are some examples of active passive income? Right here at the last bullet, salary, wages, tips would be considered active. Passive income can be dividends, stocks, and rents. So let's talk about my good friend here, Dr. Jones. This is a great example. Dr. Jones is a neurosurgeon that earned $4 million from his medical practice in which he actively participated. He also owns several rental properties. In this example, Dr. Jones earned approximately $100,000 a year from his rental properties. A cost segregation study was conducted and his rental properties generated $800,000 of depreciation. So the question is, can Dr. Jones use this $800,000 of depreciation to offset his medical practice income? And in this example, unfortunately for Dr. Jones, He could only use the depreciation to offset the rental income and not the income from his medical practice. Because again, the losses that he generated, which were the depreciation, were considered passive losses. His income from his from being a neurosurgeon is considered active. Passive losses cannot offset active income. So in this example, Dr. Jones can only use that $800,000 to offset the income from the rental properties. But there is a way around it, qualifying it as a real estate professional. And why is this important? So a lot of times when you think of qualifying as a real estate professional, you're thinking of real estate agent, right? I gotta go take some tests, gotta get my real estate license, all of this other stuff. But for tax purposes, that's not necessary. So a taxpayer qualifies as a real estate professional if they can achieve two things. One, more than half of the personal services performed in all trades or businesses during the tax year were performed in real property, trade, or business in which the taxpayer materially participates. And then two, can you meet the 750 hours of service during the tax year in real estate, participating in some type of real property, trade, or business? So if you can meet those two areas, you may be able to qualify as a real estate professional. So Dr. Jones, fast forward, after attending this landlord series, he realized, hey, my wife actually spends 15 to 20 hours a week managing these existing properties and looking for opportunities to expand their rental property portfolio and meets the qualifications for a real estate professional. So after some guidance, he meets with his accountant and makes an election through a written statement that is filed with his tax return. Now, since they file a joint tax return, the losses that, because now that she's considered a real estate professional, the losses that are generated from the real estate have now transformed to active, and now you can use them to offset any income. So you really see this a lot with high income, where you have one high income earner and then the spouse may get involved in real estate. And the reason for that is that if they can meet the guidelines of becoming what is considered a real estate professional, then now you can utilize any depreciation, any losses generated from that real estate to offset the high income earners' active income. Recapture, myths versus facts. So recapture is so often misunderstood. I hear it a lot when I'm at conferences. I talk with a lot of folks. They're like, oh man, I'm so worried about having to pay all this taxes and recapture all of this depreciation that I've taken. Well, there are two different types of gains and losses, and understanding the treatment of these is very important. You'll be surprised at how many tax returns we review, and we see that either the taxpayer or the accountant did not quite understand the rules, and they've overpaid in taxes significantly. So below is a diagram of the various types of property typically sold that results in gain and loss. So you got section 1231, and then the two subsets are section 1250 and section 1245. Section 1231 is actually one of the more taxpayer-friendly sections of all of the IRS code, because it gives the taxpayer the benefit of both worlds, right? The best of both worlds. So if you're selling an asset and it's at a loss, they let you treat that loss as an ordinary loss. But if there's a gain, you can treat the gain as capital gain. So this can be, very significant, understanding how the interplay of section 45 and section 1250 property all plays a role when you go to sell a property, can really make or break, how much money you're going to have to spend in taxes when you sell that property. So 1245 property is property that is considered tangible personal property. So that would be, carpet, cabinets, counters, all of the things that we've accelerated the depreciation on. The law states that if a taxpayer sells section 1245 property, they must recapture the gain as ordinary income to the extent of their depreciation on the asset that was sold. So the key here is understanding that the gain, that the taxes attributed to the gain the approach that we take in this case with most of our clients is that 1245 property, depending on, every circumstance is unique, but for most circumstances, if I've had some carpet in my apartment building for a number of years, when I go to sell it, that carpet isn't worth what I paid for it 10 years ago. So it's no way I would attribute, a significant amount of gain to that carpet. I would actually probably attribute no gain to that carpet, and therefore not have to pay any taxable. There would be a taxable event with the in consideration of the carpet. So that's just one example of how you can look at the various components of 1245 property, and we can work our way in a sales position to minimize the impact of 1245 recapture. Because if you do have recapture on 1245 property, it is considered ordinary, and you would pay ordinary tax rates on that. 1250 is defined as real property such as buildings and land. All right, so 1250 can generate recapture and unrecaptured gain. Recapture 1250 is typically uncommon. The more common is unrecaptured section 1250, which typically is taxed at a maximum rate of 25%. So how does this work with cost segregation? The idea behind a cost segregation study is that we're going to maximize our deductions that are treated as ordinary income. And then when we go to sell the property, we're going to treat the gain as capital gains. So as long as there's an arbitrage between your individual personal income tax rate and capital gain rate, you're always going to be in a winning position. So that is kind of key of how cost segregation and when you go to sell the property, how we treat your gains all works. This is an example of a hotel that we had a client out in California a few years ago that was looking at a cost segregation study. He wanted to understand how the cost segregation study was going to benefit him. And in essence, what we ended up doing was we did a cost segregation study. Here's all the calculations on it. But we did the cost segregation study, increases depreciation, which in essence increases capital gain, but he was able to take the depreciation as an ordinary income deduction. And in this example, his permanent cash savings on this example was $243,000. So it's really critical when you're looking at selling a property that you're working with folks that really understand the nuances of gains and losses and depreciation and how it all interplays. Part 5, energy efficiency. So I'm sure some of you guys and ladies that are on this webinar are probably, maybe building new apartments or whatever the case may be, but there are energy efficiency tax credits and deductions that you guys can also receive. One of those is section 179D. What this is basically part of it was part of the 2005 Energy Policy Act that basically said if you're building a building and it's energy efficient, you're allowed to get 60 cents on 3 components of your building, 60 cents a square foot on 3 components of your building. That's your lighting, HVAC, and the building envelope. So in essence, if you build a building that meets certain criteria, and to be honest with you, the criteria is so old that any building typically built today is going to qualify. And the IRS is kind of figured that out, so they're starting to increase the standards that you have to meet. But as currently, if you're building things that meet code today, you're probably going to meet the criteria in order to qualify for the $1.80 a square foot. So in 2021, part of the Consolidated Appropriations Act, this was made permanent. So historically, this tax incentive has expired, and Congress would come back and they would reinforce it again, and they just kept doing this until finally they said, you know what, let's just make this permanent because we want landlords and building owners to be building and making their buildings more energy efficient. So let's walk through an example. In this case, we had a 40,000 square foot office building. It met the $1.80 qualification for the deduction. And in this case, they were able to get $72,000 of deductions. If you take that by their top tax rate that this particular client was in, that's a cash savings of $26,640. 45L energy efficiency is a tax credit. This is specifically designed for single family homes, 3 stories or less apartment complexes, and this is a credit. So the difference between a deduction and credit is a dollar for dollar reduction in tax. A deduction is where it reduces your taxable income. So credits are more valuable than deductions. So credits, you get excited about credits. In this case, you can get a maximum of $2,000 per dwelling unit. So on an apartment complex, this can be a huge amount of money coming your way. The unfortunate part about this is you can see that 2021 end date, this was this provision sunset in 2021. There are talks that this will be extended if Congress can ever get their act together. But currently, anything built in 2022 would not qualify for the 45L. So projects to consider, apartments, assisted living facilities, student housing, anything that is 3 stories or less that provides housing. We can look back as far as 3 years, and the great thing is that tax credits that you cannot use can be carried forward. So 45L tax credit case study here. It was a 350 unit apartment complex. All 350 units qualified. So 350 units times $2,000 credit per unit ended up being a $700,000 tax credit analysis for this client. So a significant amount of money. So in the end, some of the important things to kind of take away is accelerating depreciation deductions by allows you to defer those taxes can really significantly increase your cash flow. Understanding the difference between tax rates can help reduce that tax liability. So, understanding, the difference between capital gain rates and ordinary income rates, and being able to utilize that knowledge, you can really reduce your tax liability. Cost segregations can provide that permanent time value of money. As I stated earlier, $1 today is worth more than $1 tomorrow, ordinarily. That is true. For any of you that are out there that, have properties or buying properties, take advantage of bonus depreciation now. It begins to phase out starting next year. So next year it goes from 100% to 80%, and then it walks back 20% each year until 2027 when it's gone. And honestly, I don't believe it'll come back again unless the economy is in, complete tank. Then it may come back. But take advantage of it while it's here, and make sure you understand whether you can meet the qualifications of a real estate professional. That's very important because, as you saw in the example with Dr. Jones, by having your spouse meet that criteria, and it's, you just want to make sure you can, if the IRS comes knocking, that you can support all those hours and documents everything that you're doing in the real estate profession. Make sure you take advantage of that, because that can significantly help you reduce your tax liability by being able to take those losses against any income that you have. I appreciate everyone's time today. There's my contact information. If you have any questions, I know we're going to have a Q&A at the end of this, but if you have any questions, feel free to shoot me an email, or that's my cell phone number there, so feel free to give me a call as well. But I will turn it back over to the moderator. Thank you.
All right. Thank you, Mr. Needam, for that excellent information. As Mr. Needam said, if you have any questions, please wait to the end of our session today to ask those questions. And I would like to introduce our next speaker, Ms. Dawn Scott, Housing Program Administrator with the Virginia Department of Housing and Community Development, who will cover tax strategy programs for our landlords. Ms. Scott, the floor is yours.
Thank you. Good morning, everyone. Let me get my presentation up. And we will get started. Good morning. My name is Dawn Scott. I'm the Housing Program Administrator for Department of Housing and Community Development. I have been with the agency since 2011, and I handle the down payment assistance program, as well as our mobility housing counseling program. And of course, what I'm going to present to you today, the Communities of Opportunities Tax Credit program. And I've been working with all three programs since I've been with the agency. And as I mentioned with the mobility counseling program, that can kind of run hand in hand with the Communities of Opportunities Tax Credit program, working with landlords. And with the mobility housing counseling program is to assist individuals with housing choice vouchers find affordable housing in higher income areas versus the lower poverty areas that they're used to finding affordable housing in. But today I want to talk to you about the landlord portion of the Communities of Opportunities Tax Credit program. And this particular tax credit program was enacted in 2010 by the General Assembly to help decentralize poverty by allowing those individuals with housing choice vouchers move into higher income areas where there's better schools, better jobs, and stuff like that. But in 2020, the tax credit program was amended to include the Washington, Arlington metropolitan service area, as well as the Virginia Beach, Norfolk, and Newport News metropolitan service areas. The eligible areas are any areas in certain census tracts within Richmond, Virginia Beach, and the Washington metropolitan area that have less than 10% poverty. In this presentation that you will receive, there's also a link to the geo mapping code where you can actually go into that link and look up your property to see if it's located in one of these census tracts that has less than 10% poverty. And in each area, as you can see, Richmond there's between cities and counties, at least 20 areas that are designated areas that have less than 10% poverty, as well as 14 for Virginia Beach and 15 for the Washington metropolitan area. These are the areas located within each census tract that's included to let you know if you have properties listed in, say, Chesterfield County, Hanover, Louisa, Powhatan. These are the areas that are eligible for the tax credit. And in the other column, this is the housing authority that actually handles the housing choice voucher recipients for each locality. So in order for you to become eligible to apply for this tax credit program, you would have to go through one of the public housing authorities to be listed and approved as a landlord that has affordable housing available to rent to individuals that have housing choice vouchers. And the same areas for Virginia Beach is listed, as well as the housing authority that you would go through to apply for to become an approved landlord with them and to list your properties. And then the same for the Washington metropolitan area. So not all of the state is covered, but a few of the major areas between Richmond, Virginia Beach, and Washington are covered for the tax credit program. Okay, and I'm gonna give you an example of how to search your address or addresses for your properties. What you'll actually do is go to this link that you have here. Once you go to that link, you want to go and put in the address. And then you can also search by the tax year. You can see where it says year, I have 2019, but you can put in 2021 to search your address. And then once you put in the address, you'll hit search. Then it'll bring up the actual census demographic data information. It's broken down by census tract, income, population, and housing. So once you bring up this information, it'll list here the address and all the other demographic information. But in order to determine the census tract 10%, if it's 10% or more poverty level, once you've come here, then you'll click on the income tab, and this will take you to that particular tab, which will show what the below poverty percent line is. So for this particular address, the percent below poverty line is 33%. So that means that it's more than 10% poverty in this particular census tract. So this particular address would not qualify for a tax credit. Okay. And again, this will show you exactly where you would look once you click on the income tab to show that. And also the link is in the chat. So if you want to kind of test that while I was talking, you could do that as well too. Or you can do it at a later date. So the eligible landlords are anyone that's an individual. You could be an individual landlord. You could, it could be set up in a trust, general partnership, limited partnership, or a small business corporation. And the way the tax credit is allocated to the individuals, partners, or members. So whoever applies for the tax credit, that particular landlord would assume the responsibility of distributing the credits in whatever manner they see fit. All landlords must be subject to the Virginia Residential Landlord and Tenant Act in order to be eligible for participation in the tax credit program. And what the act includes is that the apartments are subject to this regardless of the number of units a landlord will rent. If it's a single family dwelling and the landlord owns or rents 3 or more units, and if it's a single family unit, regardless of the number owned and rented, the lease includes the clause that states that the Virginia Residential Landlord Tenant Act applies. Okay. Now, the properties, one or more housing units are eligible. And it has to be for that particular tax year that you're applying for. So for this year, the application had ended on January 31st. So the way the program works is you apply by January 31st of every year for the previous tax year. And you must have a housing choice voucher agreement with the particular public housing authority for that particular tax year, as well as whoever is renting your unit, they are a housing choice voucher recipient. So you must have an agreement on file with the public housing authority, and the person that's renting the unit must have a housing choice voucher agreement as well too. All units, we do look at rent reasonable amounts, and they also have to pass a housing quality standards inspection. So once you become an approved landlord with the particular housing authority, they'll send you information on the housing quality standards inspection, when that is done, when you have to keep up with that as well too. All of your units or properties that you're applying for a tax credit must be located in one of the qualified census tracts for Richmond, Virginia Beach, and Washington. Anything outside of those census tracts will not be eligible, because right now the program is only for the Richmond MSA, Virginia Beach, and Washington MSA areas. I know I've had people ask in the past, what about the other localities within the state? They have not been added to the Virginia bill for the tax credit program as of yet. So I do encourage others, if you're in other parts of the state and want to take advantage of this tax credit program, to go to your, your local city council or county council and have them bring this before the General Assembly to get other areas added. But right now, these are the only qualified census tracts that are eligible in the program. Okay. The tax credit limits. When the program first started in 2010, there was a total of $450,000 per year that was available for tax credits for landlords to apply for. But in 2013, that total tax amount of $450,000 was reduced to $250,000. So now the amount that's available for tax credit is only $250,000, and that's every year. The tax credit is based on 10% of the fair market rent for that particular unit and particular area. So we do look at the fair market rent and base our calculation on 10% of that for the specific unit. So if you have a 1 unit, like a 1 bedroom, 2 bedroom, a 3 bedroom, or 4 bedroom, the tax credit will be based off of the fair market rent value for that particular unit, not necessarily saying what you are charging the housing choice voucher recipient for that particular unit. If for some reason the tax credits that are received are more than the $250,000 that has been allocated, all of the tax credits will be prorated, just to be fair, so everyone, there's enough to go around. So we would have to prorate if the amount received is more than $250,000, because that's all we get per year. Okay. And as I said earlier, the applications must be received by January 31st. Everything will be processed by April 15th, so you can receive your tax credit certificate before you have to file your Virginia state tax deadline by May 1st. And again, if you have other types of limit partnerships and stuff like that, whoever applies for the tax credit, you'll be responsible for sending out whatever amount that needs to go to the other entities. But you'll get one certificate showing what that total amount is for each property or apartment complex that you have applied for. Now, if for some reason the tax credits are not fully allocated based on the January 31st deadline, then if there's a remaining balance, then that will be allocated on a first come, first served basis. So, and I haven't had an instance where we had anything remaining. Last year, all the tax credits were allocated, and the year before, they were all allocated. So the sooner you can get your information in by the deadline, it's processed before the April 15th tax deadline. So you'll get notification, as to how much you've received or if you've received anything. And I also know if there's any unused balances not allocated for more than 3 years for that particular tax year, they will be made available first. But in this instance, I haven't had any unused balances to allocate past the 3 years. Okay. And with the application process, the application is posted online So you can go online under DHCD's website and pull the application and apply. The landlord that's applying for the tax credit must sign and date the application and submit a wet signature. So I have to receive the original application, and it must be on the application form that's on the website. Any incomplete, incorrect applications could result in ineligibility for the tax credit. I do request on the application that you do provide the name of the Housing Choice of Voucher administrator that you receive your payment from, because that's who I go to verify that you've had a HAP contract on this particular unit with a Housing Choice Voucher designee for that particular tax year. So we do go to the Housing Choice Voucher administrator that you receive payment from. So you must include that information in there. It can be, their name, phone number, and email address, because I do email this information to them. And like I said before, once we determine the tax credit allocations and it's issued, it's the landlord's responsibility to submit the tax certificate to the appropriate state tax return in order to use the allocated tax credit. And if you have questions about how to use this with your state taxes, if you have a tax professional that you work with, I would advise you to consult them, being as though I'm not a tax credit professional, but I would try and answer any questions that you may have in regards to the tax credit program. Okay. And again, like I said, if you have more information on how to claim your credit on your tax state return, you can see your instructions for Schedule CR. If it's an individual or if it's corporation, you would look at your tax instructions on Form 500 CR. Okay. And that's the end of my presentation, but this is the my address to where you would mail your completed application package to. And any questions in the chat or anything available right now? If not, then I know we're going to take questions later. If you have any other questions or concerns after we finish this session, this is my phone number and this is my email address where I can be reached if you have any other questions outside of the presentation. And if there's not anything, that's all that I have. And thank you for attending. Excuse me. These are some other resources I forgot to list on here that you can actually go to if you have any more questions. There's a Landlord Tenant Act down here, as well as if you have questions for any pass-through entity information, Virginia Housing Search, and again, the eligible property search. This is the main link that you would definitely want to go to look to see if your property is listed in those the 10% areas. Okay. And that's it for me.
Thank you, Ms. Scott, for that valuable information. I would like to jump into our Q&A session for our attendees today. So if you have any questions, please feel free to use the raise your hand icon and you'll be called upon to state your question. Also, you can state your question in the chat box on your screen. If your question isn't answered today, please feel free to contact our presenters as they provide their contact information, because we do have a good sized group here today. Thank you.
Good morning. We do have a question that was in the chat, and this is from Miss Marilyn Stevens. She asked, other than meeting the real estate professional requirement, what does one need to do to make sure one is treated as a real estate professional? And this question was directed to Mr. Needam.
So there's a written statement. It's actually a pretty simple process. You get with your tax preparer, you make a written statement that says that you are going to, that you meet the qualifications as a real estate professional, and you file that written statement with your tax return. And that's it. It's no, licensing or any of that. It's a simple statement that is added to your tax return, and it changes the treatment of the losses that are generated from your real estate, and allows you to be able to utilize it to offset any income. So it's a pretty simple process. Just meet with your accountant, tell them you meet the qualifications, make the election, provide a written statement, file it with your tax return. Nice and simple.
Thank you, Mr. Needam. We have another question from Dan asking, is the real estate professional status only beneficial if you have a loss on your RE business? And what if the RE business has net income?
All right. So the real estate professional designation, it just allows, it creates a position for you to utilize, the losses against any income. So that's the whole idea of it. If you have rental income from your real estate, then you have the rental income, and you'll be able to utilize whatever depreciation that you have to offset that. But I recommend to all of my clients that if you meet the qualifications of it, make the designation, because like in the example that I showed in the slideshow, you can have a situation where, especially in a 2-income earning household where one's a real estate professional and one's a high income earner, you want to be able to utilize that. So in that case that he just described, if he doesn't have losses and he just has income, then it's kind of a moot point. But I highly recommend making the designation anytime it's available to you.
Thank you. We don't have any other questions that have come in right now. If you have a question again and you want to say it online, if you would just raise your hand and then I will unmute your line and you can answer the question. In the meantime, we do have some other questions previously that were sent in. One is, when is the best time to do a cost segregation study?
So the best time to do a cost segregation study is when you acquire the property, right? So, if you acquire it, say you acquire a property in February of this year, I would probably look to do the cost segregation study in the tax year in which you acquired the property. It's just the easiest, the cleanest way to do it. We can do what I described as a catch-up study, so we can look back to any year. It's a little more expensive for you as the taxpayer to pay a firm like mine to do the additional analysis, but the best time to do it is in the year in which you acquire it.
Okay, thank you. We have another question from Nick Jones. He wants to know, how do you handle COVID-19 non-payment of rent tax-wise?
That is a good question, and that is outside of my expertise. So I don't really dive into that part. My focus is mostly on generating tax losses through depreciation. But if you could email me that question, I have more than enough resources here at the firm to get you an answer on that. So if you could shoot me an email with that question, I will make sure to reply to you today once I get with one of my tax team.
Okay. We have a question that came in previously. The question was, can I allocate assets myself or should I hire a firm?
So you can do it yourself, but I would say be leery of doing it yourself, because if the IRS comes knocking, they're going to say, how do you know how much this roof really costs, or how did you allocate these assets, and what methodology did you use? So you want to make sure you're using a firm that is using an engineer-based analysis. I usually don't recommend it for folks to try it themselves, even though I've seen it a lot. But if the IRS comes knocking, I've actually had that happen. The IRS came knocking, and then they came to me to do the analysis after the fact. It gets a little more difficult once the IRS is involved. So I highly recommend getting a reputable firm to help you with this. It's an engineering analysis. So unless you're an engineer and know construction, I recommend leaving it to the professionals.
Thank you so much. We have one final question that was sent in, and it's, does accelerated depreciation put me in an audit risk?
So the IRS says that it doesn't, and I don't believe, I deal with hundreds of studies a year. One, two, maybe get audited. I mean, the percentages are so low. It should not put you in an audit risk. What I have seen is that other things in people's tax portfolios put them in an audit risk. So if the IRS is looking, they may take a look at the depreciation. But typically, the answer to that question is no. It doesn't increase your audit risk. It's a well-documented idea that has been going on for a number of years. I like to tell people Donald Trump won't release his tax returns because this is exactly what he does, and he doesn't pay any taxes, which if you're in the real estate profession, you probably shouldn't be paying any taxes either. So if you are paying taxes, you should come talk to us and see if we can help you out with that.
Okay, thank you, Mr. Needam. Thank you, Ms. Scott. Oh, it looks like there is one more question we have that came in from Ms. Pamela Jones Watford. She is asking, I guess for clients that we've had come in, is there a specific number of hours you have devoted to your business per week that must be met to be designated as a real estate specialist?
So you have to meet a 750-hour threshold for the year. So, however you get there, you just need to be able to meet the 750-hour threshold. What I tell folks is, track that. You need to make sure you're tracking that because the IRS could ask, prove it. And in the tax world, it's not, innocent until proven guilty. It's guilty until proven innocent. So you have to, the burden of proof is on the taxpayer. So make your 750 hours, document it, and everything should be okay.
Okay, I believe those are all of the questions we have. If anyone else has a question, if you could please raise your hand and I will unmute your line to ask the question. Oh, and we have one that just came in. And it says, I have an RE business through an LLC and bought a car under personal name and used it for the business. Can I deduct the expense for the car?
Yes, you should be able to take the car should be, you can, so there's a couple ways you can treat that. You can take, if the business has income, you can take Section 179, or you can treat it as a 5-year asset and take 100% bonus depreciation. So there's a couple different ways you can kind of handle that. They both relatively get you to the same answer from a federal tax standpoint.
Okay, I was just waiting to see if anyone else was typing a question. But it looks like that was it. So if there are no other questions, I will end this question session and hand it back over to Ms. Pointer.
Thank you for that. Also, thank you to our presenters as well today. If you have any questions for our presenters, please feel free to contact them using their contact information. Also, their presentations are in the handout box if you would like to save those to your device. For our participants, a survey will be sent out by email using GoToWebinar. So the email will come from GoToWebinar. Please take some time to complete the survey so you can provide us with some feedback. Our next session will be held on March 22nd, focusing on legislative updates. You can also see a full list of our other webinars that we'll be having through July. For more information, you can go to nrha.us. And once again, we would like to encourage all landlords with rental properties in the city of Norfolk to lease through our Housing Choice Voucher program, which will provide guaranteed monthly rental income. Like I said, our referral listing holds all our available listings and is posted on our NRHA website. Please complete a referral listing application, which can also be found on our website, or contact me, the HCV Landlord Liaison, at 757-624-8643. And I'll also type this information in the box to contact me. I do want to thank you all for joining us today, and we hope to see you at our future webinars.